Hello and welcome to my morning note. US stock markets continue their really impressive and steady climb out of the abyss that they dug for themselves back in 2008 and 2009. The S&P 500 is now within 5% of reaching a new all-time high, which is quite remarkable and surprising to many, but apparently not to today's guest, who suggests that in fact the recovery path is following a very well-worn and exponential and predictable path. With me now to discuss this very interesting insight is the president of Wainwright Economics, David Ranson. David, thank you very much for being here today. Let's start out by taking a look at the S&P 500. And as the chart demonstrates here, at the moment they are following this exponential recovery path quite remarkably well. Explain to us why we should expect them to do so and what that exponential path is.
Well, if the stock market is driven in part by fear, fear hits people rather suddenly.
As it did.
And so everyone's trying to sell at the same time. It's rather like being in a crowded theatre and someone's cried out fire.
Right.
Everybody tries to get to the exit before the next person, and it's analogous. So if you want to sell your stocks, you'd rather sell them before the next person sells them.
Yes.
And so you have a tremendous amount of urgency to get to that exit. Once you're there and outside the exit, let's suppose it's a false alarm.
Yes.
The theatre owner welcomes everybody back inside, but the degree of urgency to climb back inside is really a lot different.
Right, you don't have a stampede back into the cinema. Right.
As they more and more come inside, they'll come in slower and slower, and the most reluctant ones will be the slowest of all.
Okay, now that's the theory. Now, you've done empirical research to find out that this actually happens in practice after previous crashes.
Well, it goes the other way. We did the empirical research first. We've had a lot of sell-offs in the past, and we saw an exponential curve behind them, very vaguely, not enough to really recognize, until this one. This one is so big, the 50% loss in the market so dominates all the other factors driving markets at the time. And when you draw a graph like this, hardly anyone can miss the exponentiality of the curve coming back. But if you go back to those 5 previous sell-offs, the exponential form of it fits them all. In slightly different ways. In this case, we have a beautiful case of a round trip.
Right.
We're almost exactly where we started. In past sell-offs, we actually got back to above where we started. And the difference between where we started and where we got back to, I think of as driven by more long-term situations and variables governing the market. I call that the alpha.
Okay. Is there any sense in which there is a lid on the potential for a recovery? How easy is it would it be for the market to actually breach that exponential line?
Yes, well, this is the statistical analysis suggests that when the market falls, it tends to bounce back. But when the market advances, there's no such tendency to reverse itself. This is a matter of the serial correlation of monthly or bi-monthly or quarterly returns. So that suggests that we could easily have these fall-offs below where we were, and then it would come back. But there are no advances beyond where we were from which we fall back. So that curve ends up not being a line drawn through the data, but the upper bound. And if it's an upper bound, then comparing where we are with the curve tells us roughly the valuation status of the market at any given time, which of course I would describe as zero.
Right.
There is no further upside.
Let's quickly show our viewers one market where there might actually be some value. Emerging markets at one point were following the exponential path perfectly, and then last summer deviated, dropped back from it very sharply. Does that imply that there is value there in emerging markets?
That's how I would interpret this one. We had the same crash, roughly the same time, and a lot of other markets too, the same climb back, the same tendency to climb back faster at first and then with less and less urgency. And then we had something happen outside the US that didn't affect US so much, and really a second crash, almost half the size of the original one. And so here's again a rebound from the second crash, and now a third crash. So it's a matter of one crash after another randomly hitting, but every time there's a tendency to try to go back to this. We think that's the curve the market's trying to go to.
Okay, David, thank you very much indeed.
You're welcome.
This is fascinating insight, I suppose. If you want a practical application of it for now, it's that the big potential gains and losses to be made out there at the moment are by those who really understand what is going on in China and the other emerging markets.